Right, and that story by Peter Mwangangi also acts as a segue to our discussion this morning. We will be looking at various subjects this morning, looking, of course, under the banner of the state of the economy. So we'll have the SGR, we'll talk about oil, we'll talk about the financial sector, how it's performing as well, and a raft of other issues. Allow me to introduce our panelists. You saw them as we were beginning the program. We have with us Mike Eldon, who's the chairman of the depot. Also, we do have with us Gabriel Negatu, who is the regional director of the African Development Bank. We have with us as well Aly-Khan Satchu, who is the CEO of Risk Management and financial analyst. We have the CEO of Kenya Bankers Association as well, Habil Olaka, with us, and the Vice Chair of Kenya National Chamber of Commerce and Industry, James Mureu. Good morning, gentlemen. Good morning. Good morning. Good morning. Right. I just want to also begin with Habil Olaka because I think interesting enough, we had the Sustainability Catalyst Award, and this is duly pegged on corporate governance as well. And we had the corporate bank topping that particular, of course, competition or awarding, so to speak. So we can see that corporate bank tops in Sustainable Financial Catalyst Awards, as we have it here. Tell us more about this particular Sustainability Financial Catalyst Award. What is it all about and why Corp Bank?
Maybe just some bit of background on that, because the banking industry came up with the Sustainable Finance Initiative. And to support that, we came up with the guiding principles that will enable the banks to be able to, practice sustainability within their lending and operations. And linked to that as well, we have created a platform where we can create capacity within the banking sector so that the bank employees can be able to operationalize those guiding principles. Now, in order to be able to create some level of competition within the banks in terms of the sustainability practices, we then came up with the awards so that banks can then be able to showcase how well they are implementing those guiding principles, not only in their lending practices, but in their own operations as well. And that's why we came up with the awards about 2 years ago. So this was the second round of awards for the competition, and we saw quite some bit of improvement from what we saw last year to what we had this year. Those banks are really aligning themselves to ensure that they are the best in the market and showcasing what they can be able to do. Right. So you saw yesterday, or rather the day before, the likes of Cooperative Bank showed quite an improvement from what they were the previous year.
Yes.
We even had a category of the most improved bank within the awards category. So there was a whole range of them, including those that focused on the SMEs. But I think overall what you're seeing is that they are beginning to take sustainability as an issue that will guide the operations going forward. Not only concerned for the economic viability or the economic impact of their operations, but also the concern for the environment and as well the concern for the society at large. Yeah.
And we can see, of course, this is a big step towards corporate governance, because I think also within the corporate governance codes, they're talking about integrated reporting, which sustainability is pivotal. It's very key. They want to brush aside, just the issue of corporate social responsibility that people use, to just piggyback on, what they extract from the environment. Then we have, the Kodak moment. They're coming to take pictures and then putting on the business pictorials in the dailies as well. They want a more integrated approach and, of course, reporting. So how does this also code or tie in with integrated financial reporting?
Yeah, I mean, sustainability reporting is becoming so key because the stakeholders are now looking for how is the business operating within its environment. How is it concerned not only about its own economic viability, but in terms of concern for the environment, concern for the society at large. And so sustainability reporting is becoming now integrated into the overall reporting for the institutions. A number of institutions are now leading ahead, and they are producing specifically sustainability reports. And you've seen these, including our members, have been on the forehead of coming up with sustainability reports and reporting on that on a periodic basis, showing the improvement they are making and the contribution they are making towards the sustainability agenda. In fact, this year, within our awards, we also saw quite a bit of interest from non-bank entities because we are looking at the overall ecosystem. And so we are looking at not only banks, but we are looking at MNOs, for example, mobile network operators. We are looking at the fintechs as well. And the entrance for this year's competition was actually, we had MNOs, Safaricom was a player, and in fact they did win in one of the categories.
Okay.
We had another fintech that is based in New York and Nairobi, and we are seeing more of that beginning to come into the awards system.
All
so
right.
Finally, I think the point is that sustainability is becoming an issue of relevance. And the point is that you are unlikely to be doing good business if you are not focusing on sustainability.
Sustainability, right. Let's just from Mike Eldon, because I think this is very key within within corporate governance, because the issue of the green bonds as well, it has been highlighted. There's also the concept of green buying as well. From your own estimation, do you think corporate governance is just a buzzword that will, with time, will be a fleeting cloud and nothing much will come out of it?
Actually, I don't like the term corporate governance very much to start with. It sounds so heavy, so stern parent, naughty child, so full of bureaucracy and going on 5-day courses with exams. I like to use more traditional words to do with even sustainability. I like, actually. So the question, though, that you ask is whether it's a passing cloud. And I'd like to think that here, as elsewhere, it isn't, and for two reasons. Firstly, because increasingly young people emerging into the workplace to join these kinds of organizations expect and wish to join organizations that do what your awards encourage, that do take care of the environment and society at large. And secondly, and I think this is lagging behind, but it's nice to think it's also gathering momentum, is that the customers wish to buy products and services from organizations that behave in that way. And it is this stimulation, the demand-driven stimulation, both from within and from customers and investors in the stock market, that will make this go. And wherever I go, whoever my client is, whether it's within government or with corporates, whether I'm doing something with development partners, everyone is focused on the Sustainable Development Goals, on the SDGs. And we are increasingly doing work with clients to help them see how to pick out 2 or 3 key ones that are relevant to them, that they can work on, that they can make a specific, identifiable, measurable contribution to on the sustainability issue. It's an emerging field. It's not rocket science. I think people like Safaricom and KCB and others who have started producing these wonderful sustainability reports have really shown us the way. It's so doable if you just decide to do it. And of course that must come from the level of board and senior management, and to be part of the culture, of the value system, and an explicit way of attracting investors, staff, and customers.
All right. Let's hear from Gabriel Negatu.
Let me start by telling Mike that I did go through one of these 5-day corporate governance courses and earned my certificate. So,
so you shouldn't poo-poo the,
I shouldn't.
The big word on corporate governance.
I'm not poo-pooing.
But I have to agree. Sustainability is an idea whose time has come. It is not an add-on that you put on your business after you've done everything else. It's a way of doing business. And it makes good business sense. Customers demand it, investors demand it, stakeholders demand it, so it's an all-round win-win situation. And as Mike said, what Safaricom and others have done to really lead the way, and in this Safaricom has just been exemplary in terms of looking at sustainability. It just means how do we make sure we're sustainable within an ecosystem of humans, environment, finance, and all of that put together, and how do we make sure that the business we have today will be around in years to come in a way that promotes to the sustainability of the environment, the human ecosystem, and the financial structure. So it's an all-round win-win type of situation.
Mm-hmm. All right, let's hear from Aly-Khan.
No, I'd just like to, my two experiences have been with Safaricom, who began this agenda, I think, in about 2008, under a lady called Sandel Giambo, and really I've seen it flower from that point. And they became real champions, not only within our country, but at a global level. So that was interesting to me as well. But I think this is obviously a good agenda. Different people are going to have to interpret it differently. Safaricom has 25 million customers. They're embedded in the society. So they are very much invested in the whole 360-degree situation amongst their customers. Another company I'd like to mention would be Base Titanium, the mining company down in Kwale, which don't blow their own trumpet. But again, I've been down there severally. They're doing mining, but at the same time creating agricultural opportunities. There's a lot going on. I come from the coast. Kwale is was a very depressed part. Just by putting in a road, creating a marketplace, helping people with what they're planting, you've got a very sustainable economy going on down there. It's well worth looking at. So I think this agenda is going to go forward. It's interesting also, everyone's talking about the consumer. If you look at the consumer, we have this kind of, I call them the avocado-eating cryptocurrency millennials. They're very different to, or to the way that we think sometimes. But, you'll see these huge spikes in avocado prices is because everyone gets onto that. It's tasty, it's good. So, they're looking for things which are kind of more meaningful at many different levels. And I think corporates that adjust to that are going to do very, very well.
You mentioned also the titanium, because I know there is also the phenomenon of the blockchain, and they're saying, can we use the blockchain to try and also track, how titanium is being mined? How do we also have the child labor market into it as well? So this is also another device, I think, that will be very pivotal when you're coming, because I think China is is the biggest buyer of titanium from Kenya as well, which is where they normally import a lot of titanium. But also in the concept of corporate governance, also the issue of labor and in the supply chain, what is the source of labor? Are we abusing children? Are subjecting them also to the labor market as well? So maybe you can also weigh in on that?
So I'm glad you brought up that issue, because I think a lot of people get mixed up between cryptocurrencies and the blockchain, and they are different things. And I think the blockchain, it's already made its prima facie case, right? I mean, we know it's going to increase transparency. We know what problems what gaps it's filling. You're talking about mining. Obviously, the interesting story that came out this week was about coltan. Coltan is the main mineral that goes in all our modern day living, the phone and everything, and the main source of it is in the DR Congo, which is a more extreme environment than ours.
Actually, right.
We will all agree.
It is a DR Congo, you're right.
So the idea was to apply the blockchain so you could track right down to where it was coming from. So I think that's a very useful exercise. But I think the point I just wanted to make finally was not to confuse cryptocurrencies, of which there are 1,550, and some are highly speculative, like dental coin and God knows what, dog coin, that didn't even exist. It was a joke, and suddenly it had a market cap of $3 billion, which is about 1/4 of Safaricom's. But, and the blockchain, I think, the blockchain, yes, we embrace it, that's the future, we can see it's coming. The other side is a bit more complex.
Right, let's hear from James Mureu.
Oh, thank you very much. I think there are two things that I want to comment. First of all, I'm happy to have Habil around. We've talked about a couple of interest rates, and maybe you need now to review what's the status of the interest capping rate and the effect it has had in the banking industry.
We're headed there.
Yeah?
We're headed there.
Yeah, because we've talked about it, we've never had the real authorities right here today, and I think we'll be able to hear exactly where. I mean, I'm glad he's awarding making these awards to the banks that have shown resilience. But he mentioned a number of things, particularly when you look at the banking sector and the entry of microfinance, and other alternatives to banking, table banking and other NMOs, MNOs that are coming into that space. And I'm wondering whether the banking industry has braced itself for what's coming, because I think increasingly, every day, a lot of the banking operations are slowly disappearing. A lot of it is in my phone here, a lot of it is in the women that operate their money and change every month without going through the banks. And I think time has come now for the banking industry really to address those real issues. In terms of sustainability, I think we're looking at the old saying that if you are going nowhere, you will never get lost. Okay. So companies that plan sustainability will never get lost. But if you're going anywhere, wherever you are, you're in the right place. So for me, this is a no-brainer. You must plan. Sustainability is equivalent to planning, good planning, because then you can actually project and be able to say, in the next 5 years, this is where we want to be. So you have a roadmap where you're going. But if you're going nowhere, wherever you are, you're right. You never get lost. So I think this is no longer a knee-jerk reaction where you say, okay, today let's try this, let's try this. Those businesses that do that are headed to the dustbin.
All right. And of course, I'm interested that Negatu mentioned the corporate codes, corporate governance codes.
And by the way, I've also done that.
You've done that as well.
And I've got a certificate.
Of course, you must be familiar with the Marvin, I almost said Marvin Gaye. I don't want to resurrect Marvin Gaye, but Marvin King, right, who actually came up with the King corporate governance codes as well. He will be in town next week to talk about corporate governance as well. I don't know if you're familiar with the King's report, the latest one, that you can tell us more, that is shedding light on what we're talking about, just briefly.
To be honest, no. I have not read the latest report, so I don't know, Mike, if you have. But let me not speak about something that I have not read.
You've not read, but of course now that's a good reason for you also to attend that particular seminar next week.
Yeah, absolutely. Yeah.
What did you say?
When is it? Yeah. We're all there. James wants to know when. We're all in the same.
A refresher course.
A refresher course for you. Yeah, it should be Monday and Tuesday.
Monday, Tuesday. Where?
But he's the best, without a doubt.
Yeah, he's the best.
Yeah, Marvin King was
but we have
next to the Cadbury codes, which came out even earlier. I think he was definitely the best in the field.
But we have our own Mervyn King here, Catherine Musakali,
yes,
who's the prime author of the Mwongozo Code and working with the Capital Markets Authority, and who appears at this table from time to time. Not to be underestimated.
Yeah, absolutely.
All right, and of course, in light of that, when we're talking about corporate governance, we need to look at how also they've managed some of these companies around in the country. We have the Capital Markets Authority that now is trying to resuscitate that particular case that went under the tubes because of, I think, a sloppy job that judges were saying that the capital markets had done on Uchumi as well. So the directors, they should be charged with some of fraud cases as far as rights issues are concerned. I don't know if you're in the loop, Aly-Khan Satchu, you can tell us more about this and how the capital markets corporate codes can affect or can be actually enforced to try and bring about good governance that we are not really seeing in most of our companies. We know what is happening with Nakumatt right now, and all this is pegged on corporate governance. We know what is happening with Umeas, by the way, yes, and of course we are given to understand they will be laying off some of their staff workers, but the board members will be getting a pay rise. So all this is enshrined when on this corporate governance code. How do you handle that when a company is sinking, yet the board members, directors, they're getting a hefty pay and a golden parachute that is not really making sense if they don't have really money to, sustain the company?
So this is a problem that's not only unique to Kenya, it's actually worldwide, and it's you're seeing a number of scenarios. I was in the UK earlier this month, and there's a company called Carillion which had entered into public-private partnerships with the government, and they went down. And so what we're seeing is a problem that I think occurs all over the world. The issue is, how do we deal with it? Have we dealt with it well ourselves? And you cited a number of interesting instances. Nakumatt, you said, Uchumi, and what was the third one, Mumia Sugar. Obviously, in Mumia Sugar's case, it's been Groundhog Day for eternity. It seems to get into these problems, gets a bailout, and then we revert back into it. And I, for one, think that, you know, capitalism has to be Darwinian. Otherwise, you're going to get these types of issues. It's unfortunate. It plays a huge role within that economy, or it should do, and it's not playing it. I mean, in that western area of Kenya, Mumia should be one of the biggest employers. It should be a successful company. It isn't, and we've got to ask ourselves, what do we do with companies such as this? Nakumatt, similarly, I mean, you know, that has been on that radar. This has not happened yesterday. This has been a slow motion crash that practically everybody I know in Nairobi, without exception, knew that there was a problem there. And we just watched this car carry on careening down the road until it became impossible to go any further. So the question is, what do we, you know, how do we handle these situations? Are we handling them in the right way? I think we're bailing out too many people. Really, I do, and I don't know, Gabriel, if you agree. I don't think we have the resource envelope to continue this kind of bailout process. And I think absolutely there have got to be consequences. And we have to have a more and quicker, efficient process around consequences. I think Uchumi, one of the charges, for example, was that, you know, the wife of the CEO at the time was the biggest known supplier to Uchumi. That's a red flag straight away. What kind of analysis are you doing that you're not able to spot a situation like that? And so I think it's a question of, we know we've got to do better, but we've also got to have some kind of process and a clear compass about what falls on which line and deal with it at the time. That's my view on the issue.
All right, but what do we say, of course, on the director's pay?
That's ridiculous.
That is pegged, not even with the part that is pegged actually on the performance of a company, right? That we don't need to award you if a company is not really performing very well.
Absolutely. So I don't disagree with it at all. I think it's egregious that those directors felt that they could act in that manner and give themselves such a pay rise at a time when they're doing so poorly. And I think that's the way to look at it. I mean, we see this again in other parts of the world as well, you know, enormous pay rises in front of a very troubling situation. So I think, you know, as a universe of 7 billion people, we've got to deal with this better, because what's happening, it's symptomatic of a very small piece, a very small percentage of the world gaining an outsized share. And I think that's also a sustainable issue. How do we make it more sustainable so that it's fairer to everybody?
All right. Yes.
But in a free market economy, part of the sustainability strategy has to be allowing companies to fail. It cannot be, there has to be a balance between protecting shareholders and employees and so on, and bailouts. But there is a limit to that.
Allowing companies to fail, predicated on the performance of the leadership, or even maybe the market forces. You know, that is diametrically different. If it's the market forces, that is something that is beyond maybe the company, that's a different kettle of fish altogether.
Yeah, but the performance of the leadership has to be, I mean, for example, these listed companies, there are enough checks and balances along the way. But when government intervenes at some point and says, no, this is too big to fail, and begins to bail them out, then you remove the incentive to do better. And I worry that, we're all concerned about employees and so on, and this ridiculous pay increases in the face of non-performance. But the threat of failing has to be there and has to be real. Otherwise, we're just not going to do it.
Right, just let's hear from Mike as well.
I come back to my earlier concern about this word governance. Actually, so much of what we're talking about here is to do with values and behavior.
Yes.
How do you behave when your company is doing badly and yet you give yourself this bonuses and so forth? To some extent, these things are taught on these 5-day courses and examined. But there's only so much you can do in terms of technical knowledge and in terms of competence. So much is to do with how you behave fairly.
Integrity.
My last article in Business Daily was about values, and people don't pay much attention to that, didn't know what to do about it. They think values and behavior is behavior, Kenya is Kenya, and so forth. But that's what we have to do. And we live in a society generally of low trust, impunity, and so forth, where too many people do what they think they can get away with doing, which is quite a lot. That is the fundamental underlying issue, isn't it?
Yeah.
And no corporate governance course is going to sort that out. I've just joined the board of an insurance company, and you have to send all sorts of papers to the regulatory body, and they wrote back eventually, having studied all my papers, and said, yes, we approved the appointment of Michael Eldon to Occidental Insurance, provided he takes one of these courses and gets certified. Now, is that going to make me a more ethical, fairer governor? I don't think so.
Another candidate for next week's course.
All right, let's hear from Habil before we come to James Mureu.
I mean, I think I'll agree with the views that have been expressed, especially on the topic, the issue about allowing, entities to fail, because effectively, really, when you protect an entity that has failed, be it because of market forces or, non-performance of the leadership, I think at the end of the day, then you are removing that incentive for them to perform better. Mm-hmm. So you can only protect so much, but you are also expending the taxpayers' money on salvaging something that went that route itself. I think that's a critical thing. But coming back to the point about aligning pay to performance, I think it has been a topic of discussion for quite some bit of time.
Yes.
We align pay of the senior management and the board, for example, to the performance of the company. But I think sometimes it's how do you measure performance? Because occasionally we have had the short-term view, where you look at the annual performance for the company, and then you link it to the pay. What has happened is that there's a tendency to, for lack of a better word, to fidget around with the performance for the year, mm-hmm. at the expense of the long-term performance of the company. So you try to beef up the performance for this year in order to, increase your pay, mm-hmm. as the drivers of the company, be it from the management or the board for that matter. Yet the long-term performance of the company is at stake. So how that has somehow been addressed is by trying to ensure that if you are talking about a bonus scheme, you vest it over a period. Mm-hmm. So that as the company continues performing over the long term, you then get your benefits along the line, so that your actual remuneration or pay is linked to the long-term performance of the company rather than the short-term performance. Mm-hmm. But still, we still get challenges. But I think it will be a debate that will continue tackling between aligning performance to the pay structure of not only the board, but the senior management of the company.
Right. Finally, let's hear from James Mureu, because you raise a very important point where we have just a fig leaf, of giving, the balance sheet of the company as per that moment without the projection of the future. And I think this is also what really Enron was doing, just pulling wolves over our eyes. It seemed to be working better in the stock exchange, but surely they knew something was amiss, and it was a tinderbox waiting to explode. How then do we peel back some of these fig leaves, and we get to the real, circumstance, of the real picture of that particular company? Let's hear from James Mureu.
I think for me, Debarl, I think we have thrown common decency out of the window. If you look at the institutions that have failed in this country, all of them fail in the full glare of what is going on. We all know that people misuse other people's property. A case like Nakumatt, for example, like Aly-Khan said, was seen a long time ago, when they failed to pay within 30 days, within 60 days, within 90 days, 180 days, 360 days, 720 days, whatever number of days. Increasingly, they were using, and they were allowed to get away with that. And for a long time, people raised issues about non-payment. Right now, as a private sector, mm-hmm. I can flag, and have done that in this forum here,
yes,
that we are owed by the county and the national government upwards of 200 billion shillings to the private sector, unpaid bills, and we have rendered services. And I don't know for how long this country can sustain that sort of model where people get away without paying for what they have already enjoyed. Governments and county governments, national governments and county governments, and the private sector has borrowed from that. So it's really a gravy train. Everybody's just milking.
Yes.
And then let's look at how are these CEOs of bad performing institutions treated.
Yes.
They're heroes in this country. They are the ones who are made from killing this institution, you're promoted to go and kill another institution. And then before that, you're made a member of parliament. And before that, you're made a cabinet. There is no punishment for such wrongdoings.
And after that, you're an ambassador.
Yes, and for that, you know, we must, the country must punish punitively this kind of behavior. And there must be a way of really just flagging. Don't touch this man with a 20-foot pole. He is poisonous because he has poisoned here.
Thank you.
I mean, Mumias itself was premised. I mean, Mumias Sugar was Mumias Town. Mm-hmm. Everybody was dependent on Mumias. So when you put it down, you're putting the economy down. You should not be allowed to hold any other public office. Right. You should be punished severely at that.
All right. Welcome back. You're watching In the Market here on AM Live. And of course, we continue with our conversation on the state of economy. I'm holding court this morning with the chairman of the depot. This is Mike Eldon, who's a management consultant, also the chairman of KCA University. All right, gentlemen, we're on air. All right. Also, we do have Gabriel Negatu with us as well, who is the Regional Director of African Development Bank. Also, we have Aly-Khan Satchu, the CEO of Rich Management, a financial analyst, Habil Olaka, the CEO of Kenya Bankers Association, and James Mureu, the Vice Chair of Kenya National Chamber of Commerce and Industries. We continue with the conversation, yes, on sustainability, corporate governance, and we need to pick out these companies. First of all, before we took a short break, I promised to circle back with the issue of the double pay or of the board members of Mumias. Should this happen?
No.
Not at all.
It can't happen. I mean, the company's on its knees. It hasn't made a profit for about, I don't know how many years. This is not the first bailout it's dependent on. It's about the fourth or the fifth. You can't, clearly you can't, in such a scenario, make an argument that somehow the board are working extra hard to turn the business around. And as far as I'm concerned, I've seen nothing out of this company. No strategy, no business plan, no anything to say that what they're going to do over the next 2-3 years, which is going to make a difference. I think absolutely not.
What is there to discuss?
Mm-hmm. Yeah,
but this is crass stupidity, because I think if you ask me, we built out this company with 1 billion shillings, isn't it, in the first place? They are laying off workers, and they're getting a double pay in the first place. They should explain what did they do with the 1 billion shillings before they
directors are supposed to give some directions. If they're doing none of that, they deserve nothing. In fact, they should head up to jail for misappropriating public funds.
So is Mumias Sugar a basket case, Habil Olaka?
Well, I wouldn't say it's a basket case because I don't have the exact details of the operations of Mumias per se. But I think you raised an important point.
But just generally looking at the corporate governance itself, how have they been managing this company?
I think from what is coming out of the fact that on one hand, we are doubling the pay for the directors, and then on the other hand, that cost is effectively being met by the employees who are being, retrenched. I think in that there is no collective responsibility for the performance of the entity, because the performance of the entity is being reflected on the retrenchment, isn't it? Mm-hmm. So the employees are having to pay for it by them being kicked out. On the other hand, the directors are being rewarded for some performance that we can't see. Because we can't see any positive performance that can justify that doubling of the pay. So there's some disconnect there, you see. And I think if that is the way it's proceeding forward, of course, as I said earlier, there is the caveat that we don't know the actual details about the rationale behind that decision. But I think on the face of it, it looks inappropriate.
But the bailout, the bailout itself should have stipulated what that money can be used for. And part of that money cannot be used for rewarding non-performance. And if that has not been stipulated, then you ask, is it a basket case? In a country that's importing sugar, how can a sugar factory be a basket case? Under the right management, in the right hands, this should be a very profitable business.
Absolutely.
All right.
But this is the whole sugar sector, isn't it?
Yes.
The
because look at
whole
Sony.
sector has never got its act together.
Sony.
And you
Ramisi.
compare even South Sudan, they do it so much better. Why there? Why not here of all places? Ridiculous. Even with the supermarkets, you look at Uchumi and Nakumatt, there's the underlying assumption, and it's not just here, Tesco did it, Walmart did it, that you can grow and do well by being financed by zero interest from suppliers. So you've got to look beyond the individual organization and what happens and what is okay to happen to a whole subsector where everyone's doing it, so everyone's doing it, and because they keep on doing what they've always done, they keep on getting what they've always got. And so with Mumias, in its context, there's radical rethinking needed as to how we can make our sugar industry competitive, the relationship with the smallholders, how you stop allowing these imports and who's doing it, and we know enough about that to know that it should stop, particularly at these times of crisis where you're creating a shortage and then you do this and then you do that.
Right, so,
you know,
yes.
if I want to put it figuratively, Debarl, if you have a bucket that has got 10 holes and you keep adding water, when will you fill that bucket? For me, I look at it, if you bring $1 billion into an institution like Mumias, you must first of all seal all these holes. Now, these holes are where you have a board that is irresponsible, indecent, they don't care about, because if you increase your allowances or your pay, knowing well the real situation you're faced with, then you're really indecent. And so, even before you put a shilling into that institution, you must first of all diagnose what's the problem, what is ailing this institution, why is it failing, why is it not performing. Now, once you've come up with a list of those problems, fix them, bring change managers in place, and then bail them out. But it's doing the same thing over and over again and expecting different results. It'll never happen.
In fact,
so we need to fix those.
Part of that bailout should include a salary decrease by the board and management. Everyone should take a haircut. It can't just be the taxpayer.
Until the company is afloat.
Yeah, is back on its feet.
Yeah.
You know?
So do you think also privatization, because I think this is the word that has been bandied around in the sugar sector as well, will be the magical wand?
You know, I was disappointed because there was a period when Kenya was at the forefront of the privatization process and culminated in the selling of shares in Safaricom. Prior to that, we'd had a whole series, and it was a real win-win.
Yeah.
Why? Because companies which were inefficient in the public sector became more efficient as they got privatized, and we saw this in several instances. It took underperforming companies in some cases off the government's balance sheet. It created more of an ownership economy in Kenya. There were, millions of shareholders flocked to buy KenGen shares, for example, and suddenly it all went dead. When did we last have a big IPO? I can't remember.
I can't remember.
We've had a lot of little ones, so I think privatization is a great idea, and I'm surprised that the government is not more keen on doing it. I would certainly be doing it. I think the secret is to just make sure you sell at the right price and people have a profit in their investment, and it's not too difficult to do, and you don't leave them nursing losses. That's the worst idea. And let's get that back on track. I really think it would be very, very helpful. I don't know how many companies the government is invested in. I saw a number of over 1,000. And I was going, wow, what does that mean? There's just optically it makes no sense. So there must be a lot of opportunities for us as a country to look at that whole thing. I would certainly be inclined, particularly now with debt to GDP moving upwards. We need to be a bit more nimble and quick about the way we go about things, particularly the Eurobond. Friday and Monday we saw massive volatility in world markets. We saw big moves. I think we cannot assume that the markets are going to be benign, and we would be wise now to pull the trigger quick on at least a $2 billion Eurobond, because I think we do have to now look at how our sequencing of debt is also happening, and we need to push it out longer.
All right, thank you. And I think Mureu had raised the issue of the banking sector with the interest caps, but I want also Habil to shed light on the new accounting rules. that is signaling a rise in monthly loan charges. If my director may just pick up on this. And they say that they face a higher monthly loan payment as lenders shorten credit tenures in line with the international financial regulation standards 9. Tell us more about this, because now we thought, yes, our loans will be cheaper. It seems also you're trying to revise this. I think negotiations is in the pipeline with the governor of the central bank that you want to bring back, you know, the interest, you know, back to where it was. So are we just batting our heads on the wall, or this will actually fructify in the long run?
That's quite a mouthful, but I think let me start from the IFRS 9, because that was the first question. I think it's the accounting framework that is changing. If you know about the rules on international accounting standards, there is a new standard that is called the IFRS 9.
Yes.
And it's replacing the previous one, which was the IAS 39. And the difference is just a basic way in which banks look at their provisioning, the credit portfolio. Yeah. And one is futuristic.
Yes.
The other one has been more or less on the past. So previously you incur a default and then you provide for it. Now in the new regime, in the new framework, you will now be looking at an item that is entering your books, and you look at the probability of default going forward.
Yes.
And then at the point of entry, you have got to book that provision commensurate with the probability of default, you know, going forward. So the difference is that initially you had to wait until it occurs.
Yes.
On the basis of incurred before you book the actual provision. Going forward now, it will be over the next 1 year, what's the probability that this will default, and then you have to book it. So the difference would be that especially for some specific sectors and specific segments of the credit market, you may have to book provisions earlier than you would otherwise have done in the previous accounting regime. So, and that's why there's concern of the fact that the impact of that would be that banks will have to book higher provisions for some sectors. And this, you're talking about the sectors like SMEs, for example, where the perception of default is likely to be higher than initially where you are waiting for it to occur before you book for it. Now, the chances, therefore, of compounding the already existing problem that was created by the interest capping law is bound to be compounded, you know, going forward, so that the sectors that were having the negative effects of the law will be even more affected by the implementation of the IFRS 9. And we're talking about the SMEs, for example. We're talking about the individual borrowers, unsecured credit. Those are the segment of the credit market that will be significantly affected by the new accounting standard. So
with this accounting standard, if I'm servicing a loan, does it mean also that the length of period that I was given to service this loan will be actually shortened, or maybe it's for the new, the new customers that will actually be coming to, look or apply for some loans?
I think it will mainly affect the new customers, because the way the bank now, or the credit provider, be it the bank or whoever that is looking at the credit application,
yes,
will now have to look at what's the probability of this application defaulting over the next 12 months. And then you have got to book that upfront. Initially, you did not have to do that. You booked it in, and depending on the performance, you then book the provisions accordingly.
All right. James Mureu.
Yeah. My issue with the banks here is very interesting, because I think what Habil is saying is partially correct. But if you look at what the banks are practicing today, first of all, they sort of have refused to spread their risk. They would much rather take a chance with 2 or 3 big companies because of the so-called track record, and they take a risk such that if they gave me, for example, 500 million shillings today because they think I'm creditworthy, if I go down with the entire 500 million shillings. But they have neglected an important sector, the SME sector. And for a long time, I've cried about this SME sector. It's the bottom end of the pyramid. That is where you have the critical numbers. That's where you can also spread your risk as a banker. Today, they want to take very little risk by looking at somebody they think is less risky to lend. And they refuse to address the real borrowers who are largely the SMEs. Now, if 500 million shillings is given, for argument's sake, to 1,000 SMEs, you have spread your risk. They don't need a lot of money, but you can spur a lot of growth from that SMEs. But the banks today look at, they'd rather give unsecured loans to salaried staff than to support a Juakali guy who is making jikos, who is making furniture, who can grow, who has a potential to pay back these loans. But the banks want to come to an established institution that they don't quite understand the ongoings. They give a huge amount of money to one person who goes down and goes down with everything. Personally, as a banker, I know for a fact that if you spread your risk to 1,000 people, you're better off. Out of that, you find actually, and contrary to what a lot of banks believe, the SMEs are faithful to pay their loans. They honor that. Some do have genuine problems. And when it's time to sort out their problems, it's the bank that should come and hold hands and say, okay, guys, here you are doing badly. Let's try and figure out how we get you out of here.
Right. Let's say from Mike Eldon, we'll come to you, Aly-Khan.
I think a further aspect is how banks are still operating, not only here, but in some other countries, including in the developed world. The whole customer journey is still very long and very uncertain, and at times you're given a more optimistic assessment of your likelihood to earn the right to a loan, and then there's a setback. But meanwhile, you've made commitments on the basis of the earlier higher expectation. And the whole thing takes too long, and then it goes to the credit committee, and the credit people are more risk averse because they fear being hammered for approving loans that turn out to be non-performing. And it's a very awkward situation for people in branches and people in business development generally who are trying to stimulate business, who are looking potential borrowers in the eye, and then removed from them is a credit person just looking at numbers who has no sense of the individual and being more risk averse, demotivating all the other people and actually making the potential borrower now no longer viable.
Absolutely.
That is a big, big challenge. And I've been reading articles about how the banks that will survive are those that make the customer journey shorter and sweet.
Sweeter.
That doesn't mean to say you take undue risks, but you make your decisions. Not making a decision is introducing a new source of risk that too many banks seem not to appreciate.
Exactly.
And what you have is a lot of good people in the banks, wonderful Kenyan friendly customer oriented people held back by systems that prevent them getting on with a job for the benefit of the borrower and the bank.
Right, Aly-Khan.
100% right.
So just to say that, you know, the SME sector is the engine of growth in sub-Saharan Africa. There's various statistics that prove that, and here as well in Kenya, it's a huge machine for growth. So if it's optimized, it's going to deliver more growth and it's going to create more jobs. I just wanted to make the point for big banks, you know, for a long time it was the cost, the channel cost. The cost to evaluate 1,000 SMEs and make loans to them of 50,000 shillings is just not worth it, right? Because you've got to deploy a number of people. The cost of that deployment was expensive. So so banks kind of said to themselves, this is really not worth it. Now what's happened in the meantime is we've had a revolution in the mobile phone.
Exactly.
We've had a collapse in the channel cost to get to the customer. We can potentially, there's a proliferation of fintechs who are dissecting and diagnosing your creditworthiness based on your phone call history. And we've got a revolution happening there, which ties back to the point that James was making at the beginning, which was about this moment of massive change in the banking sector, of which I have no doubt. And when I look at it and I think to myself, you know, what is going to be the most successful bank in 5 years' time? if I was just entering, I just want to be a digital bank,
Yes.
no branches, you know, operating on high-end artificial intelligence.
Yes.
And that makes me very worried right now for a number of banks who are not necessarily
Yes.
seeing that future
Very rigid banks.
and
Why not?
understanding.
Why aren't they?
I don't
It's
know.
so obvious.
And the
It
thing
is
is, you
very
know,
obvious.
it's very difficult when you're in a legacy environment to shed the legacy quickly enough, right? I mean, so you keep thinking, oh, so you continue to cut back each year, but you're not kind of embracing the future, and suddenly it's there. It's some guy out of, you know, some smart IT guy who's now built a business which is serving 2,000 SMEs, for example.
I mean, quite honestly, you must ask yourself, when do you ever go to the bank?
Yeah.
When you have your mobile phone?
Yeah.
I mean, and slowly, then now what will happen is you'll have a situation where there is no need to go to the bank. You'll have an exchange where now somebody will come with an innovative idea where you put your money somewhere else, not in your bank, and you can access it when you want it, and the banks will render themselves relevant.
Maybe Habil needs
Habil
maybe he needs to actually distribute the Ken Blanchard's book, Who Moved My Cheese, to every bank right now, because it seems your cheese is moved, and you're still sniffing, you know, just the leftovers within the bank, because he's talking about the future of the bank. Do we have the mortar and the brick? Do you need all these branches? Now everything is on your mobile phone, right? Aren't you reading the writings on the wall as a sector? Because even now, we talked about the bitcoins and the cryptocurrency, and of course we've had statement from central bank saying, of course, we will be non-committal on the digital currency in case you lose.
Coming.
Yes, but it's a storm which is coming. Maybe we need to take a keener look on it. What Japan is doing, I think, in South Korea as well, right? Embracing cryptocurrency, because I think that's another avenue. That's the storm that is coming. That we need to be prepared.
Yeah.
Who moved your cheese?
Yeah, I think this is good feedback, and one of the things that KBA is there for is we get quite a bit of feedback from the market, and then filter that feedback into the banks for them to take a look at what kind of reaction you're getting from the consumers and all that. So this is good feedback. But I think, having said that, I think the message that is coming out is the fact that the customer is looking for convenience, is looking for ease of transacting, and is looking for, if anything, reduction in the cost of banking services or cost of the transactions.
And speed.
And speed, yes.
Speed.
And which comes really into the convenience. And one thing that Aly-Khan mentioned was the fact that there are all these other players that are coming into the market. There is the mobile money operators, there is the fintechs, there is the microfinance. And if you check, what has been happening is that there is quite a bit of cooperation occurring between the banking sector and these other players. It's no longer that one of competition, but it is, you know, collaboration. So there's quite a bit of riding onto the platforms available, for example, to provide mobile banking. There is quite a bit of development in the fintech area where banks are collaborating with fintechs to be able to provide the service better. Because what the fintech is really doing is that they are coming in to say that there is a better way of doing this. There is a better way of leveraging on technology to be able to provide the convenience or all the good things that you wanted from the banks. Efficiency in terms of reviewing, for example, the application. If you're going to do it manually through the whole process, it's taking much longer than if you're going to leverage on the fintech to be able to automate the process and have it done much faster. But I think, having said that, there is another thing that we need to remember. And towards the end of last year, a number of banks started closing their branches in response to the environment in which they operate. So they're trying to jig their model to be able to operate in the new environment. And one of the things was, first of all, reducing the staff numbers, reducing the branch network, and leveraging on the existing other channels for delivery of their services. But there was hue and cry from the market. In the sense that we're talking about job losses, we're talking about, in fact, that insensitivity to the customer was again coming up. There is the issue of trust. And there are consumers who will not want to rely on the mobile. They would rather go and talk to a human being in the bank. And you need to give them that opportunity to be able to still continue liaising with an actual human being. There's that human touch that's required. And so banks will not just close branches and move out, because they have developed that touch with the customer and they have got to maintain that touch. But the point is taken that we need to look at our business model and be able to integrate or take in the feedback that you're getting from the market in terms of the wants from the customer and provide it. And that will require leveraging on the existing partnerships with the fintechs, with the MNOs, and the other partners.
All right.
Parting shot.
Parting shot on this, yes.
Yes, on this one. I know you are pressed with that. But I really partly agree with Habil in so far as what they are doing is concerned. What really I'd like to see is the banks starting from a point of trusting a customer. Because if you go to a bank now, a lot of people are averse to going to the bank because the bank manager doesn't trust you. So you start by, I don't trust you. This is a con man that is coming to try and steal money straight away. That's the introductory to your bank manager. So if you change that mindset and you start by trusting somebody until they prove they're not worth your trust, then you will start changing their mindset and start transforming and doing what banking is supposed to be, i.e. collecting deposits and lending out. Now, if you look at the interest rate capping that happened, and we've discussed that interest rate capping here. Are banks making losses now? They're not. The only thing is that we have managed the appetite for profit, and they are continuing to report. They may not report 35 billion, but they've reported 18 billion or 15 billion.
Yes,
it is still a profit.
Right.
And I think that is where now you should now manage that financial sector so that there is more accountability, there is better ways of dealing with your customers, and you're able to relate and do what banking is supposed to.
And I think Habil has been playing some very nifty, fancy footworks with that on the interest caps. You've not told us. You promised you will.
Yeah.
We want to know. Yeah. What is the development on this? Are we batting our heads on the wall? Will we see a new development?
No,
the governor mentioned it. So are you going to revise it?
You know, he brought up an interesting development where he was talking about the fact that banks are shying away from SMEs and preferring to look at the established borrowers, the ones who are credit-worthy, so to speak, in preference to the unsecured and the SME. And maybe it has become more apparent over the last 1 year or so. And it's not a coincidence. It is a derivative from the law, the capping law that was passed. So banks are trying to readjust their models to be able to fit within the law. And one of the consequences that comes out is the credit rationing, where you try to, when you are appraising your, your credit portfolio, you are looking at the applications that will be able to fit within the law. So now that the law is talking about you cannot lend at anything above 14%, you are trying to review your applications to see which of these can fit within that 14% limit. And anything that has got a risk profile whose pricing will go above 14%, will not take it because it does not make economic sense. No wonder some of the riskier applications are the ones that are being put aside, and the ones that fit within that, and it does not surprise you that they are the bigger established borrowers who can demonstrate their credit worthiness, that are able to get credit. But moving forward, I think the critical thing is the fact that the reason why the law was passed was there was a concern. There was a concern about the level of the cost of credit in the market. And that has not gone away. So even as we debate about whether to remove the capping law or not, I think we need to address the basic problem that there was.
Yes.
And we also know the fact that the evidence available over the 1 year that the law has been in place is not positive, because some of the examples that he has given are the consequences of that. SMEs have been denied credit. They have not been able to access credit. The private borrowers, the individual borrowers, the unsecured credit, which was really boosting economic growth, have not been able to access credit. Now, so what are we doing? I think one is that we, being alert to the fact that there was a concern, we have tried to put some framework in place to ensure that when this is addressed and is removed, we do not go back to the old ways where the rates were all over the place. We have recently introduced the cost of credit website, where a customer can be able to effectively check the cost of credit across various banks. And therefore, you can effectively vote with your feet because you can move from one bank to another based on their credit offering.
I guess we need just a whole sitting to discuss that as well.
Yes,
there's a lot of weekend.
Yeah, but I think the critical thing is the fact that the consequences of the law have been negative. And for us to be able to drive the economic growth that we are so much in anticipation of, we are very optimistic. By the way, I saw 6.2% projection from Central Bank, 5.5% projection from the National Treasury. And for us to achieve that, we have got to unlock credit.
Thank you.
And to unlock credit, we need to address this.
Yeah, let me just give this chance to Gabriel to sum it up, then we move on.
Yeah, just to respond to Habil's point, the credit worthiness is not a function of size. You know, you can be big and unworthy, and you can be an SME and very credit worthy.
Yes.
So what this law has done in this country is it has brought some discipline into borrowers. Because in the past, banks would just give out loans knowing well that they may have some issues, but they would always cross-subsidize it with the good borrowers. Now, by vetting out the non-good borrowers, small and big, and seeing who is eligible for a 14% cap, I think you are disciplining the borrower into becoming creditworthy and so on. So is it a negative impact? I'm not sure. And as he said, this will require another sitting. But on the role of banks and going forward, you know, banking is not a science. It's you're looking at a person and saying, will this person default on my loan? Now, the old bank the function was to borrow and to take your deposit and to lend it to me. Not anymore. That's not what I want from my bank. I need more. And where you have these other added services, you cannot leave it to some app to sort you out. You really need there's no replacement for human judgment. There always will be a need for that. Do you need more branches? Not necessarily. But the role of judgment, in human judgment and credit assessment and so on will always remain, because fintech will only take what you have and make it better. But they don't introduce new products per se.
Right. Okay. Let's see also the performance of the shilling and Aly-Khan. This is where, because the shilling hit a new high against the dollar recently. I don't know how it is performing right now. I haven't checked. So 102,
Yeah, less than 102. I think yesterday 101.30.
101.30.
15th, 16 month high. I think it's caught a lot of people wrong-footed. Quite an interesting move, I think. Look, I think the shilling, we've got to keep a close eye on oil, because that's our single biggest expense item every month, and that was going up quite sharply, but it's now coming down. My view is probably that the recent move higher in the shilling has been driven by a lot of money that wanted to come in on the infrastructure bond. Central bank stood firm, rejected that money, and I think that money sat around waiting to come back in via the tap. And that's one of my prognoses. Also, you know, we notoriously undercount remittances. We probably had some extra remittances, so it's quite an interesting development. The shilling, you know, if you look over the last 12 to 24 months, has been, frankly, the most stable, best performing sub-Saharan African currency, bar none. I can't think of any other one. And in an environment where so many countries have two-tier FX systems and you can't change money at the official rate, it really is a very impressive situation. And I have to give credit to the central bank and others for managing our FX operations in such a manner. It really is impressive. I look at the FX markets all over the world. It really is impressive.
And we can talk about, because I think there we had that Kenya is the third largest domestic user of the dollars in the EAC. In light of what we have right now, we can talk about the dollarization of the economy with what is happening with the shilling right now. So it seems we won't really get some, bang from the back as well.
So dollarization, I don't think we're as dollarized as other economies. I think, part of the credibility of the shilling is that the shilling is used much more in our economy than maybe you'd find it in other countries where people really price in dollars. I mean, my wife is from Malawi, your rent is in dollars, your this is in dollars. No one wants the FX risk because it could be anywhere. So I don't think the dollarization is an issue in terms of, I think, we should be proud of the way the shilling has
stood
traded
up, yeah.
and has been managed, and it, you know,
No doubt.
people look at Kenya and like our free market credentials. You can bring your money, invest it, take it out, take your money out for a 50-cent bid offer spread. That's really an achievement we've got to be careful not to lose, because it's hugely advantageous at the moment.
All right,
I don't want to be too proud of them.
Yeah, no.
I don't want this shilling to
No.
keep rising.
No.
It's something to watch.
Yeah.
Something to watch.
You can shed some light, because I think also the stock market, I think from Wall Street, there was shock and panic that rippled and cascaded to so many countries. What was happening there? I couldn't really wrap my mind on what was really happening with the Dow Jones and all.
Me again?
Yes,
okay,
yes.
so what I think is, you know, we've had a Goldilocks period in the financial markets. The Dow Jones has been going up in a straight line. The president cloaked his administration in the righteousness of the markets, and, you know, look at the Dow every day, and that's how good my economic policy is. So it's problematical for him at the moment. And I think what triggered it was actually a news on Friday of wage inflation in the United States. For the first time, you know, there's this theory that inflation is dead in this new gig economy. Prices are continuously going down in a way that's never happened before. But we saw an uptick in inflation and wage inflation, and that triggered massive worry. Why? Bond yields are at record lows. Central banks all over the world have been printing money, buying their own bonds, suppressing interest rates in order to stimulate their economies. And all of a sudden, the US is saying, okay, we're going to rein this thing in. And the general sense is it's got to be reined in worldwide, whether it's Europe, whether it's Japan. And I think that makes money dearer, interest rates go higher, equity prices cannot be priced to perfection,
yes.
And suddenly you got all that volatility. The famous saying about the US is, if they sneeze, we all catch a cold. You saw that over 2 sessions. The contagion goes worldwide. Nairobi, we saw uptick in volume. We traded $1 billion shillings 2 sessions in a row, and we've been languishing a little bit. So you could see we'd imported some of that volatility. So I think that very benign environment that we've all had, the cheap money that floated all the way into the cryptocurrency markets, the frontier markets, emerging markets, where the spreads for emerging market borrowers are the tightest in 5 years. We're going to see some unwinding of that. And it could be very, very volatile, and things could move quite quickly.
Right.
And that's why I'm saying, you know, let's get our bond done quick.
Thank you. All right, unless any of you want to weigh in on this very briefly, we move on.
I was just going to say, you know, because Aly-Khan mentioned about the volatility, and I think one of the things that the domestic markets we have managed quite well is managing that volatility. Look at inflation, for example. Look at the forex market. I think over 2017, and even the environment we were operating in with the extended, electioneering period and all that, we still managed to keep an eye on the foreign exchange market, where the volatility was minimized. And any attempt at speculation, creating volatility in the market, you would see the MPC coming in, weighing in quite well. So I think that is one thing that I think we managed to do pretty well. And projecting going forward, I'm seeing central banks still projecting the fact that inflation will be kept within targets. The exchange rate will be, stable over the projected future, and therefore I'm seeing similar kind of interbank rates being maintained within range. And so I'm seeing a projection of stability, going forward.
Thank you. Very briefly.
For me, all these things are very good. The stability that we've enjoyed. However, politically now we must be
volatility.
Yes, volatility. That is what can actually bring down all these good gains. So for me, the message is to the politicians.
Isn't it interesting that yes, now that we're in January, the shilling actually is performing very well? Yeah, was it politically instigated that it stayed where it was for the longest time at 1 or 3? Only the decimals were changing.
There's only you can stretch your rubber only up to a certain extent, and I think time has come now. We've stretched this country, and I think it's like juggling with 10 balls in the air. We can't add another one. And politically now we must remove this heat and allow the economy to start regenerating itself.
Thank you.
We lost a whole year in terms of economic activity. I think the politicians must now take politics back to the parliament and sort it out there and leave the economy to regenerate itself.
All right.
Yeah.
All right. I want us to actually look at Kenya's debt burden. And I think Gabriel doesn't like us when we talk about this particular Kenya's, because he says, oh, of course, it is sustainable. Yeah. But interesting enough, we have a report and some of the economists from the African Development Bank there, and they're warning Kenya risks difficulty in paying debt, right? No. And according to your economist, Kenya could struggle to meet its public debt obligations as loan matures this year. This is the economist at the African Development Bank. You said this, and it appears to be a veiled warning against the borrowing frenzy. This is what we do have here. So you are warning us. You've been here telling us that this is sustainable. Right now also we're looking forward to actually getting a loan from China. Experts also are warning Africa on new debt crisis that is on us as well. So Gabriel, how would
you need to call Governor Nderitu here, because he's the one who is very fond of that topic, and he always says it's not going to hurt us.
And the Chinese firm are to lend Kenyans 25 billion shillings to electrify SGR.
You know, listen, the time has come when we need to look at debt in a more nuanced way. Not all debt is born the same, okay? Yes, we maintain, as does IMF and everyone else, that today, as we speak, Kenya's debt is still sustainable. But it's a warning that you cannot continue to borrow either from the local market or from the international market, because the debt burden is going to be unsustainable.
But look, we're still borrowing 25 billion shillings to electrify the standard gauge railway.
Yeah, but you know, what are you doing with this money? You know, you can.
Yeah, that's
you know,
the question would be. The question would be when actually we were coming up with the standard gauge railway.
That's the question.
Didn't we really know that we're going to electrify it, and actually to put it on to put it forth on the cost benefit analysis? Why is it coming right now? And I think the projection before was that we need 40 billion shillings. Right?
No,
that was a figure that was being.
These are two separate issues. One is why didn't we electrify then? That's another issue. But in terms of the borrowing, let me focus on the borrowing, and you can ask someone else on why it wasn't electrified at the time. But
Mike will tell us why.
Yeah, why it wasn't electrified.
Maybe it was in the board.
Borrowing. You know, borrowing for the standard gauge is not a bad idea. It really is not a bad idea, because this is an asset that is now in this term, and I think the president has made it very clear. This government is focusing on sweating the asset. We built the port, upgraded the port, we built the standard gauge railway, we built the power centers in Olkaria and so on. And now we're talking about industrial parks around Naivasha, for example.
Yes.
This is putting the standard gauge to work. And this is how this is going to pay back. So borrowing for the standard gauge is not the same burden as if you're borrowing for consumption purposes. So Kenya needs to be careful, and I think the government, to its credit, has said this year will be the year of consolidation. Less borrowing and more thing. But this is a problem across the region. It's not only a Kenyan problem. Our warning is across the East Africa region that governments can no longer borrow to finance even infrastructure. Even infrastructure, because there is a point at which infrastructure does not yield return. And these countries, Ethiopia is very close to that limit. Kenya is close to that limit. And several East African countries. So the message we're giving is we need some innovative financing mechanism to build infrastructure, but not public sector borrowing, because that appetite has to be tamed now.
So are we crossing the red line, Aly-Khan? We actually also looking forward to borrowing, or to actually having the Sukuk bond as well. So China has given 25 billion. We don't know how much will be from the Sukuk bond as well. I don't know if Sukuk bond, is the Sukuk bond still in the pipeline? I have no sorting idea.
Later in the year.
It is, it's still.
Later in the year.
Yeah, late in the year.
Yeah.
Look, I think overall, like sub-Saharan African countries, of which we are one, Ethiopia is another, and a number of other ones, have pushed the debt to GDP ratio up towards, in our case, in Ethiopia's case, around 60%. We're getting closer and closer. I think at 60% it leaves you with very little room for maneuver. A discontinuous 10% price move in your currency moves your debt to GDP out considerably. So you're starting to lose your margin for maneuver. So I agree with Gabriel, and I think what we've got to do is look at more innovative ways of putting important debt on the balance sheet. We've got to look at how we're dealing with our own balance sheet, be a bit more innovative around it. And I think also we've now got to look at our investments with a very clear focus: return on investment and speed of return on that investment. We can't do too many big projects which we're saying they're great for in 10 years time or 20 years time. Meanwhile, we're all running along just trying to carry this burden to stay still. It's not possible. So I think we've reached that tolerance level where we've got to look at, we've got to be like a CEO. What kind of return am I getting? When am I getting it? Oh, 10 years down the road, maybe I got to look at it coming to me much earlier. So you got to look for those types of things, in my view.
Right. Let's hear from Mike. We'll come to you, James.
Clearly, the last implementation of the Jubilee Manifesto was about these big hit projects, the SGR, the laptops, and so forth. This was the way that the Jubilee government was going to make its impact, and it came with big debt, not least Chinese. My sense is that for the next 5 years, Uhuru and his team's idea about building legacy is not so much based on this big infrastructure that requires big lending. And within that shift is a shift towards more devolution and towards building, as you are saying, these centers of job creation and wealth creation and tax creation along the line of the SGR, and building sustainable cities. We're back to our initial sustainability issue. I know DFID has a huge project to support sustainable cities along that line. And the other question, of course, is that going back to what we've discussed here before, what is the money being used for? And if it is used too much for recurrent expenditure, then that's a no-no. And we know, nothing new here, that we're spending too much money on recurrent expenditure in the public sector. Exactly. There are too many people and too many SUVs and too many all the rest of it. Not to mention the cost of the ongoing politics and the disruptive effect of that. So again, looking at it with a CEO's hat on, how are you managing all of this to get the return on investment, to reduce the cost of government, to spread devolution, and to achieve the legacy that Uhuru wants and that we as Kenyans all want? In the private sector, we're talking a lot in the chamber, in KEPSA, and in all the sectors about how we're going to work with the Big Four, with the Medium-Term Plan 3, within the context of Vision 2030. Our big challenge is that, yes, it's nice that our growth isn't gone below 5%, but people are asking, so who's growing, who's benefiting, and who isn't? But we still need to get to that 10%. And we still could if we did a good job as CEOs of driving strategy to implementation.
Thank you. James Mureu, on this, very briefly.
No, I just want to weigh in on the issue of the SGR. And I think for me, the question of why it was not made electric right at the beginning is the million-dollar question. However, if we are going to spend 25 billion and make it electric and make it more efficient, then we're not going to be a worried nation. The problem here is, if we can get this money that is being used for recurrent expenditure to partly fund that, reduce our government expenditure, recurrent expenditure, to partly fund this. Now I'll tell you, I'll give you a little example. One time we were questioning President Kagame about how he's keeping Rwanda Air on air and is making $12 million loss every year. And his answer was straight and simple. The overall good of Rwanda Air, if you were to really analyze Rwanda Air in its entirety, you must look at not just the flight that it takes from here to Nairobi or from here to Nigeria, but the business that it brings back. So if you look at the overall performance of the SGR without really zeroing down on how much is it paying back, what about the people who are trading using the SGR? What about the people who are traveling at a lower cost using the SGR? So in all this,
but that is bound to change, because of course they're having new rates that will
no. Overally, Debarl, if you look at the efficiency of that SGR has brought to this country, and you price that, then it's worth every penny we are spending on. My worry is not so much of what we are spending in infrastructure projects. My worry is how much we are going to spend in recurrent expenditure, considering now the government has been enlarged. That for me is a worrying question.
Can I just put one quick small response? You know, I think further south, I just want to point something out about infrastructure. Part of this infrastructure spend is to cement our position as the route to the global market, for not only for Kenya, which is what James is talking about, but also for other parts of the region. Now, I've got to say that we are facing a very fierce competitor down south, and we're not evaluating the level of his competitive threat effectively. Why am I saying that? Under our noses, it looks like he's going to steal the railway, right, via a Tanzanian route, which really the sine qua non of our SGR was that we were going to connect all these countries. So my first concern is that. My second concern is that pipeline that he also took to Tanga. And after all, you know, we're talking about somebody who came from the infrastructure docket. And my worry is, and I don't know, James, whether you agree, that if I look over the last 24 months and forget all the other noise about whatever else he's doing, he's competing very, very fiercely with us, and I'm not sure we've picked up how quickly and how fast and what gains he's made.
Right. And of course now we are actually also shoehorning some of the cargo transporters to, you know, actually use the standard gauge railway against their own wish. I think this is
no.
What's the story there?
This is a story, because people have been complaining that of course we know that our economy is premised on the philosophy of willing buyer, willing seller. So this is actually negating the possibility that anyone could be forced to consume a good or service they do not want. That is the situation on the ground, and
I'll tell you when you concoct the truth with a lot of lies, it doesn't make sense. For a long time we've had ICD in Nairobi, Inland Container Depot in Nairobi, in Eldoret, in Kisumu. Just because there is a new one in Naivasha does not make cargo offtake from the port any less efficient. Now, the old railway could not offtake the kind of cargo that the new SGR is taking.
But that is not the question. The question is why are the cargo handlers forced to use the SGR?
Debarl, it is not the truth. They are not being forced to take. It's more efficient for somebody who's taking their cargo to Uganda or to Kisumu to offtake it from Nairobi. It just doesn't make sense to insist that it must be taken. We are decongesting the highway. The highway has become another land train when you have 1,000 trucks plying the highway. Now, with the railway taking only a paltry 300 containers per day, it's so small, it's so insignificant, but you're putting a lot of politics around this. It's not the truth. And the truth is, even for the off-taker of the cargo, it is more efficient to have it railed to Nairobi, and then you have less cost to take it to Thigi.
All right, thank you.
So that's the truth, but we must start telling ourselves the truth about the railway. It is a good thing, it's efficient, and the truth is I'm using the railway a lot of times. If you take the 3 o'clock train, you're here at 8 o'clock.
Right,
if you're concerned that government is forcing, and underline the word forcing, people to use the train, policymakers simply have to turn around and say, okay, we will not force you, but we will put 1,000% tariff on the use of the road, trucks.
Exactly.
And then they will go
then
to the train.
the issue.
Yeah, so it is an efficient way of doing it, but you do it voluntarily.
All right, so we want to electrify. We have the CS telling us, of course, Masinga Dam, we are looking at a looming crisis. The water level is going down.
Geothermal.
The geothermal.
Forget water.
Forget water.
Geothermal, wind. So much natural green energy. I mean, the government must also remove itself from the traditional power generation, hydro power generation.
I think that is what we need to also discuss next time, but we will really start for time. One more issue before we go, as your closing remarks as well. We have the business, or not the East African, carrying this particular story about the China and the fish markets. And people are complaining right now. Of course, we know the big four, one of it is the food security. So why are we importing fish from China? We have enough, blue economy to sustain this country. We are blessed with the school of fish in this country. Is there any rhyme or reason, if we may just pick up what we have on the touch screen, of us importing fish from China?
Let me take the first crack on this. And the simple answer is not for long.
The smart screen, yes.
Yeah, not for long, because the strategy in the big four is that the fishing industry today, only 3% of the fish fished in Kenyan waters is processed in Kenya.
Yes, true.
So the president has made it very clear
Zero.
that Kenya will process its own fish. So this story in a year or two will be invalid.
Invalid?
Yes.
So in the meantime, our fishermen, they should suffer, because this in a year or two will be invalid?
It will take time to transition, but the fishing industry is going to come back roaring.
All right, Mike, what do you think?
Well, it's interesting, and it's not only fish. My friend Jane Gigi, who's the CEO of Kenya Flour Council, tells me she saw beans imported from China in a supermarket the other day. But I like what I hear here, and I think that with this big four now as being the emphasis rather than big infrastructure, there is good hope that in particular all aspects of agriculture, whether it's livestock, whether it's fish or whatever, we're going to get serious about it. Sugar too, as we were talking about before. But it does require that industry focus, partnerships between the private sector, the sector boards in the counties, very much county focus. There's wonderful initiatives in the coast counties, in our friend Diritu's cluster, about getting serious about making livestock work.
Thank you.
For the livestock and for the farmers.
All right, Aly-Khan.
I'm from the coast. I love my fish. I don't like that tilapia that's coming out of China. I've just reminded I had some lovely white snapper down there, really fresh. Look, we are not utilizing our blue economy. I mean, as Gabriel is saying, we're getting like 3% out of every 100 we should be getting. We got to take ownership. These got to be our fishing fleets. These have got to be our fish processing plants, and we've got to get into value addition and supply the global markets out of Mombasa. It would transform that economy.
Right. The banking sector. The Chinese are coming as well. Better be prepared.
They're already here. But I think on that point about the development of the fishing fishing sector, I read the CS's comment, response on why are we importing from China when we have got Lake Victoria, also producing. And I think his response was the fact that there was to bridge the gap, the demand gap, because what you're producing and what the demand is, there's a gap, which lends down to the point that Aly-Khan raised, of the fact, actually it was the fact that it's a short. It's not before long, because soon you are going to increase our capacity to produce to meet the demand, and will not need to import. In any case, I think the point he was raising was the fact that it was not that the fish had to come from China. It was to bridge that gap. You look at the market was available, and apparently the cheapest must have been China. But in the same story, I think somebody mentioned the fact that that fish is tasteless.
Right, fish made in China.
It's tasteless.
Let me say this, and this is at the risk of sounding as pessimistic as, we don't need to import fish from China. There was a big program that was encouraging people to have fish ponds everywhere across this country to be able to generate enough fish for the whole country.
Thank you.
What is happening now is, if China is first of all not able to feed itself, are we being fed with fake fish here? Is this fish genuine? Has it been checked? Is it pumped up with growth hormones so that it grows fast enough to come and feed Kenyans? Personally, I'll be very worried about that, and I would, as a government policy, ban importation of fish. Let us feed Kenyans, because we will have another effect. I can tell you this is processed fish. By the time the effects on that fish takes its toll on human beings, will be running huge health bills.
Thank you. Banning is not the answer.
Right, thank you, gentlemen.
They should not be. They should not be encouraged.
Quite an incisive.
Let's be let's just.
Thank you, James.